Hello, everyone, and thank you for being here today. My group and I will be presenting Chapter 5, Cash or Liquid Asset Management. To begin, allow me to introduce myself. My name is Alexa Gonzalez Leyva, and I am joined today by Maria, Katie, and Sharon. To introduce this topic, I'll define cash management. Cash management is the management of cash and liquid assets. A liquid asset is an asset that can be easily converted into cash in a short amount of time. Examples of liquid assets include checking or savings accounts, stocks, bonds, funds, and other similar investments. The purpose of cash management and keeping your money in liquid assets is to plan for the unexpected by developing an emergency fund. It's basically the classic planning for a rainy day. The importance of this chapter to us is that it provides insight on how to effectively manage the liquid funds that make up your emergency fund. So, to continue, cash management is deciding how much to keep in liquid assets and where to keep it. In the past, cash management was very, very simple. It was just putting your cash in a checking or savings account at your local bank. But now things have gotten a bit more complex, they've gotten a bit more complicated, and they've changed. Now, banks and other financial institutions offer a wider variety of financial services for us. And the key to understanding how to manage your liquid assets is to understand the differences in financial institutions, their products, and their services. So you may have two questions right now that are on your mind. The first one may be, why even keep money in liquid assets? So the answer is simple. It's to pay your bills and cover your normal expenses with ease, as well as your unexpected expenses. Say you get in a car accident or something happens to your car, now you have this pricey repair. All you just do is take that from your emergency fund and you're good. Nothing's really disrupted. So, in keeping money in those liquid assets, you avoid having to dip into your long-term investments, sell your stocks, your real estate, etc. when you're in need. It made it all simple. Another question may be, why not just carry cash? And the reason is it's easy to spend. And many times individuals cannot even recall where they spent it. I mean, I don't even know the amount of times I've reached into my purse and found a 20 I didn't even know I had and spent it. I have no idea where. A good way to think of liquid assets is to think of them as a reservoir. Basically, money moves in as wages are received and money moves out as expenses are paid. Therefore, money moves in and out, and a sufficient level of liquid assets will keep the reservoir from running dry, so you'll always have that solid emergency fund. Though, as usual, it is important to consider the risk-return trade-offs associated with keeping your money in liquid assets. Because liquid assets can be easily converted into cash with no loss, there is little risk. But due to that relatively risk-free nature, they do not provide a high return. Another risk associated is that the more cash one has, the more cash one spends. A good way to summarize this, something to keep in mind, is that liquid assets are defined by low risk and low return, but they are very safe. Savings. It is important to automate your savings by having money deducted from each paycheck and put straight into a savings account. It's always good practice to pay yourself first. This is an easy way to make saving less of a chore. It's just done automatically. It's not even a thought, and it helps maintain a budget really simply. And it's good because you're less likely to spend money if it never becomes part of your liquid assets reservoir. A good thing to think of is the time value of money. The earlier you start saving, the easier it is to achieve your long-term goals. But there is a disadvantage. The potential disadvantage could be that savings account may not earn as much as a brokerage, not earn as much return as a brokerage account.
All right, so we are going to talk about financial institutions. So a financial institution is basically any company or any institution that facilitate financial and monetary transactions. Most of the time, they act as intermediaries between two parties, and they facilitate these transactions. And there are two main types of financial institutions. The first one is a deposit type, which is basically a bank, and the second is a non-deposit type financial institution. Although there are differences between them, these differences have narrowed significantly over the past years, and they are almost interchangeable nowadays because they've almost followed the same functions. So the main functions that these financial institutions take care of are deposits, loans, making investments for you, and currency exchange. So financial institutions are a very big and important part of the economy in almost every country. And just to highlight how important these institutions are, we have a question here. In a developed economy, who has an ongoing or at least periodic need for the services of financial institutions? Virtually everyone. So if you live in a developed economy, there's a very, very high chance that you use one of these financial institutions for your day-to-day life. So first up, we have banks or deposit type institutions. So these are basically the traditional institutions that provide checkings and savings accounts. So first we have commercial banks. So these offer the widest variety of financial services, and they also have the widest network of branch offices and locations. And so they're able to keep a personal relationship with their clients. And some of the biggest services they offer are checkings and savings accounts. They have credit cards, safety deposit boxes, financial consulting, and all types of lending services. And commercial banks also have the biggest amount of assets compared to every other type of institution. And then next up, we have savings and loan associations and savings banks. So both of them provide the same type of services in that they provide savings alternatives to banks. And they were both started as institutions that provided mortgage loan to depositors. And although they offer similar services to banks, they have higher interest rates compared to commercial banks. And lastly, we have credit unions. So these are nonprofit organizations that are open only to members. So for example, it could be members of the church or a university or trade unions and things like that. And how it works is that at the end of the term, only the members from that organizations are given dividends from the investments. Next up, we have non-deposit type institutions. So although there are some differences between these types of institutions and banks, these differences are narrowing, and they provide almost the same type of services now because of the deregulations that happened in 1980s. And the first type of institution is a mutual fund company. So in a mutual fund company, what they do is they pool investments from different investors, and they invested in stocks or bonds, and the investment is then managed by a professional investment manager. And the interest earned from bonds and dividends earned from stocks are given out in distribution as income to these mutual fund members that initially invested in it. And secondly, we have stock brokerage firms. So traditionally, they only invested in stocks, but now they compete with commercial banks and offer very similar services like banks, including credit cards, loans, and almost anything else you can think of. And lastly, we have insurance companies. So this is also another type of non-deposit type institution where they create a contract between the client and themselves, and they guarantee payments against losses from specific contingencies or perils. So next up, we have online banking. So almost every bank these days have online banking services. And these services include checking your balances from all your accounts. You can transfer funds between your own accounts or to someone else's account. You can pay bills online. You can set up automatic bill payment, recurring payments, say for your phone. And you can view your financial information through the internet, a phone, or any other electronic device that you can access the bank's website in. And some of the advantages are personal financial management support. So you can download all your financial statements or any kind of information you want of your account through online banking. And convenience is a big thing. You can view your accounts. You can make payments online much faster, much quicker, and it's a lot more efficient because you can manage all your banking needs from just one place. You don't have to go to the bank to get things done, and also the effectiveness. So because these online banking platforms are able to show you different rates, your investments, how secure it is. So it's just generally more effective. And some of the disadvantages include the startup time. So it might take some time to get used to the online banking platform, and just adapting that it might be difficult. And some people just don't feel comfortable enough to use online banking and have their banking details online. And lastly, customer service. It might be slower to get good customer service online as compared to going to a bank's branch and just talking to someone at the bank. And after that, we just have a few considerations for when you choose a financial institution. So when you're looking for a financial institution, so you want to consider your wants and needs and compare the types of services that you're looking for to the services that are offered by the bank. And you also want to make sure that your investment is safe at this bank, and that you study the reputation of this bank. So this is particularly true for new banks that start online. So say a Chase bank account might be safer than an online bank that you haven't heard of. So you have to compare that as well. And another example might be a traditional savings bank versus a cryptocurrency wallet. So because the crypto wallet is susceptible to hacking, you might not want to put your money in there. And you also want to consider the costs and returns associated with the financial institutions and choose the best way to go about it, and compare whether you want higher interest rates or safety of your investment.
Hi, my name is Maria Brea, and I will be talking about the different cash management alternatives. When deciding which cash management alternative to use, you need to decide to take into consideration how risky or safety it is, examine return to see comparable interest rate, and also take into account their tax status. So we first have checking accounts. Checking accounts are federally protected accounts in which you deposit your liquid funds so you can withdraw them quickly and easily by means of written check or debit cards. We have two types of checking accounts: interest-bearing and non-interest-bearing. Interest-bearing are types of accounts that pays interest, and non-interest-bearing is a demand deposit account. Some advantages of the checking accounts is that it's liquid and you have a low minimum balance. However, disadvantages are the monthly payment fee, also that a minimum balance is required, and that checking accounts pay less than other alternatives. Then we have savings account. An account is an account that lets you store money securely while earning interest. Some advantages is that it's liquid, it gives higher interest than checking accounts, and it gives you quick access to money whenever you want to. Disadvantages is that you have to hold it for a minimum of time, you have a balance required, and you have low interest rates for these types of cash management alternatives. Then we have money market deposit accounts. You earn interest at a higher rate than standard savings accounts. This is insured by the Federal Deposit Insurance Corporation, and it's offered by commercial banks. Advantages of the money market deposit accounts is that it's safety, you earn more interest, you have check writing privileges within 5 to 6 checks per month. Disadvantages is that it has a high minimum balance required of $1,000, and it is like a low interest rate type of alternative. Then we have certificates of deposits. Here, the savings alternatives are paying a fixed rate of interest while keeping the funds on deposit for a set period of time. This can be within 30 days, 2 years. Advantages is that you have a fixed interest rate, you have a payroll deduction plan, which can be convenient, and you have relatively high interest rates. However, if the fixed interest rate is high, rises, it is bad. Also, you have a minimum deposit required, and you have penalty for early withdrawals. As high as you hold this type of alternative, you will have higher interest rates. Then money market mutual funds. You here receive interest on a pool of investments deducted by the administrative fee. Advantages here is that you have high interest rates, you also have better returns than usual bank accounts, and low risk due to the short maturity of this type of alternative. Disadvantages of the money market mutual funds is that it's not federally insured, so it's unsafe or unsecured. You have a minimal initial investment between $500 to $5,000, and it charges administrative fee, as I already said in the definition. Then we have asset management accounts. These are financial services packages offered by brokerage firms and investment banking, such as checking accounts, credit card, debit cards, or money market mutual funds. Some advantages is that you receive monthly summary statement. Also, you have unlimited check writing privileges, and you have higher returns. Disadvantages of the asset management account is that it's not federally insured, so it's unsafe or unsecured. You have a minimal initial investment of $10,000 in stock and cash, so it is costly. Then we have the US Treasury bill. These are short-term US government debt obligation backed by the Treasury Department with a maturity of 1 year or less, and is sold in denominations of $1,000. So when you first purchase a US Treasury bill, you don't receive interest. However, it's in a form of appreciation. Once the US Treasury bill matures, you receive the face value of $1,000. So the advantages of the US Treasury bill is that it's risk-free, it's secure or safe, and you are exempt from state and local taxes. However, due to the fact that it is risk-free, you have lower rate of returns. And lastly, we have US savings bonds. It is a form of government debt issued to American citizens to help fund federal expenditures. Advantages is that you don't have sales commissions or fees. You have different purchase channels, such as payroll deduction plan. It can be online or at financial institutions. It is affordable, and you are tax exempt if it is used for educational purposes. These advantages is the low liquidity, longer maturity, and other investments or cash alternatives may earn more. You can also have a penalty if it is redeemed before 5 years. So for taking the best investment decision, interest rates needs to be considered. It can be difficult because sometimes these interest rates can be compounded annually, quarterly, or daily. So the annual percentage yield is used to compare all investment opportunities, and is also referred as the equivalent annual rate. The APY formula converts interest rates compounded for different periods into comparable annual rates, allowing you to easily compare interest rates within different investment alternatives you may have. Taxes also affect the real return on investments. And when you are comparing these types of investments, the rates should be on the same tax basis, either before or after tax. So the after-tax return calculation is the taxable return times 1 minus the marginal tax rate plus non-taxable return. You need to consider both federal and state taxes. And as high as the marginal tax bracket, the higher the benefit you would have from tax-exempt investments. Here we have an example. Imagine you have two money market mutual funds. You have Fund A that is tax exempt and pays 5%. Fund B that is taxable and pays 6.5%. The tax bracket here is 25%. You want to choose which of the two is the best alternative. So Fund A after tax return is 5% as it is non-taxable. And Fund B after tax return, we use the formula, we have 6.5% of taxable return times 1 minus the marginal tax rate of 25%. Which gives 4.875%. In this case, of course, Fund A is the best alternative as it provides a tax-exempt return of 5%. However, imagine if you have another alternative where you have a marginal tax rate of 10%. Here, you use the formula again, and you have 6.5% as taxable return times 1 minus the marginal tax rate of 10%, and you will have 5.85%. So this confirms that as high as the marginal, as high as the tax bracket it is, the higher the benefit you will have from tax-exempt investment.
Establishing and using a checking account. So just to reiterate, a checking account is a federally protected account in which you deposit your liquid funds. So this allows you to withdraw money quickly through a debit card or a check. Step one in this process is choosing a financial institution. You should consider the 3 C's. So that's cost, convenience, consideration, and safety. I'll go into further detail on the next slide about this. And it's always important to remember that when you're opening a checking account, that you're also forming a relationship with the financial institution. So you should consider the convenience it is for you and also how comfortable you are with the bank's managers and employees. Next, we have the 3 C's again, but in more detail. So for cost, we have fees, rates, minimum balances, and also per check charges. Convenience is the location relative to you, access to ATMs, availability of safety deposit boxes, availability of direct deposit services, and also availability of overdraft protection. For consideration, it's personal attention provided to you by the bank and also the financial advice that you are comfortable accessing. And for safety, it's federal deposit insurance. So that means that the FDIC, which is the Federal Deposit Insurance Corporation, protects your money in the unlikely event of a bank failure. So the insurance amount is usually $250,000 per depositor, per insured bank, or each account ownership category. So if you open a deposit account in an FDIC insured bank, you are automatically covered. Balancing your checking account, there's a few important things to remember. So you should keep track of every transaction, meaning every check you write, every deposit, every ATM transaction, and put it into your check register. So when your monthly statement arrives, compare it to your check register to make sure that there have been no mistakes made. By reconciling all your register balance with your monthly statement you receive from your bank, you can locate any errors you or your bank has made. So there's an equation on the right side of the slide. To determine your ending balance, begin with your ending statement balance shown on your monthly statement. To this, you add any deposits or credits you've made since the statement date. Then you subtract any outstanding checks or debits issued by you, but not yet paid as of the date of the statement. The difference should be the ending balance on your current statement, which is the adjusted statement balance. Next, we have overdraft protocols. So overdraft protection is an automatic loan made to your checking account or your bank credit card whenever your account doesn't contain enough cash to cover the checks that you've written against it. So any checks drawn against a checking account or a credit card with overdraft protection will not bounce. So this also goes for any debit card usage as well. Standard overdraft practices, your bank will cover your transaction for a flat fee of about $20 or $30 each time you overdraw in an account. And then the second way banks can cover your overdrafts is the overdraft protection plan. So your bank may offer a line of credit to you or a credit card or even a link to your savings account in order to cover those transactions that you overdraw on your account. These plans may be less expensive to you depending on what you choose, and this might be less expensive than their overdraft practices. There's 5 rules for debit and ATM overdrafts. So the first one you choose is your bank must get your permission to apply any of their standard overdraft practices to an everyday debit card or ATM transactions before you can be charged overdraft fees. To grant this permission, you must respond to the notice that they send you and opt in. With existing accounts, if you do not opt in, your bank standard overdraft practices won't be applied to your everyday debit card and ATM transactions. These transactions will typically be declined when you don't have enough money in your account, and there won't be an overdraft fee. So new accounts, if you open a new account, your bank cannot charge you overdraft fees for everyday debit card and ATM transactions unless you opt in. So with flexibility, basically it means if you opt in, you can cancel that at any time. And if you do not opt in, you don't, or you can decide to do it later. So checks and automatic bill payments, Basically, the new rules do not cover checks or automatic bill payments that you may have set up for paying bills such as rent or utilities. Your bank still may automatically enroll you in their standard overdraft practices for these types of transactions. If you do not want this, you can talk to your bank and see if you have the option to cancel this. So the other types of checks that you can use is a cashier's check, a certified check, a money order, and a traveler's check. So a cashier's check is a check drawn on the bank's or financial institution's account. So people without a checking account can use this, and every check you take out usually has a fee of $10 plus the amount of the actual check that you want. A certified check is a personal check that has been certified by the financial institution on which it's drawn. So you must have sufficient funds in your account, and also it's $10 per certified check. A money order is a variation of a cashier's check. So this isn't usually issued by a financial institution. It might be the US Postal Service, or you can also get one at a convenience store like 7-Eleven. And a traveler's check, they usually don't have a specific payee, and they come in specific denominations of 20s, 50s, 100s, and it's similar to a cashier's check, and it's usually issued by a large financial institution such as Citibank, Amex, Visa, etc. So an advantage of a traveler's check is that they're accepted almost anywhere in the world because they are viewed as riskless checks. And also if they're lost or stolen, they're generally replaced quickly without charge.
So lastly, we have electronic funds transfer, or EFT. So EFT is basically any financial transaction that takes place electronically. And some of the main transactions that happens this way are ATM transactions, debit card transactions, smart cards, stored value cards, and new forms of online payment like Zelle that Bank of America uses. So this is a very rapidly changing field, and there's innovation and new technology coming out in this area almost every day. And some of the advantages of using EFT are transactions take place immediately. You don't have to carry cash or write a check, so you're generally safer, and it's more convenient mostly. And you can pay all kinds of bills using EFT. Some of the examples from just everyday life could be paying for your groceries with a debit card, or withdrawing cash from an ATM, and transferring money to someone else. And just to describe all of them in a little more detail, an ATM is an automated teller machine, so you have instant access to cash, and it's the most convenient way to withdraw money. But it can be costly due to fees, because banks charge a hefty fee based on where you are and which bank's ATM you're using, and it also attracts crime, unfortunately. Then we have debit card transactions. So a debit card is basically something that looks like a credit card but acts like a checking account. So you have direct access to your checking account and your money, and this allows you to access your accounts electronically. Then we have smart cards. So smart cards also act like debit cards, but the account is actually magnetically stored on the card itself. And smart cards also have access to any kinds of IDs that you put on there, or your health insurance, or anything that you can put on there. But allocated funds can run out, and there are issuer limited usage limits. Then we have prepaid debit or gift cards. So this is basically a card that has a preset amount on it. There are two main types of prepaid debit or gift cards. So one is single purpose or closed loop cards. So this can only be used at one store. So you have an Amazon gift card, you can only use that gift card at Amazon. Then we have multi-purpose or open loop cards. So this is the same concept, but it can be used at a variety of different stores. However, many of them have activation fees and maintenance fees and ATM transaction fees. And with that, we conclude this presentation. Thank you.